What's going on, everyone? Steve Place here, and today we're going to do a much more developed market primer because the past week we saw some catalysts, we saw some episodic pivots in some macro data that I think requires us to take a step back and look at some bigger picture stuff. So this video is going to be a little bit longer. We're going to talk about some macro and some asset flow and things like that. So if you want to get through this a little bit faster, you should be able to increase the playback speed on whatever platform you're reading or watching this on. So this is the way I approach the markets, where it's not just about price action. It's not just about fundamentals. It is a combination of three things. You have underlying catalysts, you have the underlying liquidity of the stock, and then you have the narrative that's being pushed forth by various market participants, whether it be company leadership or if we're talking about macro, certain elements of the people that control the narrative to dictate price action. Those people will be involved as well. And this runs in multiple directions. So for example, a lot of people will see the price action from this past week and attempt to attach a narrative to it, when in fact much of the price action that we saw this week was just a function of positioning and a lot of bigger trades being unwound. But they're going to attach a narrative to the price action, and then that can become reflexive and that can become self-fulfilling and then go back and affect the liquidity of the stock or the market. Catalysts can be things like earnings or FDA events or big macro pivots, look like what we saw recently. So the first thing that we're going to look at is liquidity. I think this is the most important aspect of it right now. We do have macro concerns with respect to not just the US markets, but the Japanese markets as well. I think that the current price action that we're seeing has more to do with liquidity and positioning than it does to specific catalysts as it stands right now. Okay, those narratives might shift and change and cause a different liquidity structure in these stocks. It could see a widening of the bid-ask spread, and just things get a little bit more volatile in tech stocks as well as the Japanese yen. So that's going to be something we'll discuss. But first off, we did have a period of lower liquidity in the market overall. There was smaller volumes. There's not going to be as much size on the bid-ask spread. We saw this one last push to the upside in some of the Mag 7 stocks. And so we are seeing a little bit of an unwind right here. This is a chart of the S&P. The NASDAQ looks a little bit worse because it is going to be more tech heavy. The S&P was holding up well due to rotational dynamics with respect to banks and healthcare and industrials. So that helped buoy the S&P on its own, while the NASDAQ got absolutely obliterated due to a lot of the other trades unwinding. So we had the stage already set for larger price movements simply because there wasn't that much liquidity to absorb the new volatility. All right, there's always going to be a relationship between the volatility of the underlying asset and the liquidity. If there's no bid, then volatility goes crazy, right? If there's a very large bid, then volatility starts to go down, all right? So that's what we're looking for there. The next thing is that we did see a Mag 7 unwind. So this chart shows us the relationship between the NASDAQ 100, which is market cap weighted, and then QQEW, which is an equal weight NASDAQ 100. So each component, 100 components, are going to have an equal weighting. And what we saw over the past few months and basically the half of the year is that the returns in the market were not well distributed. They were in things like Nvidia, Apple, Microsoft, Meta, Google, Amazon, and whatever the seventh stock that I always forget. There's one more in there that I always neglect to mention, but there was an unwind that took place. And this matters because we started to see the correlation trade unwind. So one of the bigger trades that was going on was a dispersion trade, where, what's the best way to put this? Let's talk about the opposite first. When markets are very volatile, everything moves on the same giant macro conveyor belt. If you think about very stressful times in the market, March 2020, DES 18, the fiscal cliff, the taper tantrum, the great financial crisis, Apple and Amazon are going to move in lockstep. There's not going to be a whole lot of separation between them because everyone's focused on index flows and much larger movement, which is derived from that increase in volatility. So when the market's quiet, Apple moves up a little bit, maybe Amazon moves down a little bit. You have Meta that has good earnings and then they gap up. And then you just get these things that aren't very correlated, and the market overall, the index on its own, gets quiet. And so there's an institutional trade called dispersion, which I'm not even going to try and explain too hard, but it's basically trading the volatility of these individual components against the volatility of the index. And the idea is, as long as the returns have a different dispersion than the returns of the market, then you're going to get an edge. So that got blown out. Correlations started to significantly increase, and then the dispersion trade saw a big unwind. So if you had a lot of people who were selling a bunch of index vol and then buying individual component vol, if everything goes to one, then the hedges that you have on the component volatility are not enough to absorb the losses from the index vol. I'm pretty sure I got that right. It's not a trade I do, it's just an institutional trade, but there was a lot of size attached to it. We did also see a rotational market where, and this was before everything got really blown out at the second half of the week, where the Russell 2000 index, after that Fed cut, saw a very large rally while the NASDAQ started to see a pullback. All right. And there's been this anticipatory rotational idea that's been underneath the surface for a while. And we did start to see it play out where large cap tech started to get hit, but then the banks rallied really hard and the small cap stocks rallied really hard and healthcare stocks started to see capital flow. Because when Nvidia is a $3 trillion stock, if it pulls back, that's going to be $300 billion of capital. Now, some of that's just paper money. It doesn't actually exist, but some of that money does come out of Nvidia and it needs other places to park it. All right. And we started to see that play come out, and then everything started to unwind all at the same time. We've also got an AI trade that started to unwind significantly. So Nvidia saw a decent correction. The semiconductor sector started to see a decent correction. There was, and there still is, structural risk with respect to Nvidia and its weighting in a handful of indices. So XLK, which is the Spider Tech ETF, currently has a 20% weighting in Nvidia, which means 20% of the price movement in that index is going to be tied to a single stock. So that represents a little bit of risk because you can end up with convexity where, let's just say you've got long Nvidia and then Nvidia goes down, but then you've got the people who are long XLK and then they start to sell their shares in a panic. And then the ETF custodians have to go out and sell Nvidia on the market, and it causes negative cascade. I don't think that's going to be a huge deal, but it could end up being a deal where the ETF component risk becomes a convexity risk in the market. You also had short volatility get blown out of the water. And this is going to be, there was just way too much size in this. You had, on the institutional side, variance swaps, you've got short VIX, short VXX, short puts on the index. There was a pretty decent trade where funds were getting leveraged exposure to the treasury market and using some of that cash to sell equity volatility. And the trade did exceptionally well for the first half of the year, got too crowded, and now we're seeing an unwind. The magnitude of the volatility expansion that we saw in the options market on Friday gives me a little bit of concern. All right, and that's the biggest short-term risk where because we've seen a continued concentration of liquidity into 7 stocks and a continued concentration of liquidity into the options of those 7 stocks. And then you think about the 0 DTE options on the S&P, way too much size in the VXX, and you get an instance where the derivatives market dictates the movement of the underlying index. And that's been a thing for a couple years, but every once in a while it gets a little too far over its skis and then the whole thing breaks. February 2018 was a great example. You were long XIV, which was an exchange traded note that was a net short volatility product, and then the volatility markets blew out. That trade got vaporized, and it caused a massive run in volatility products, which bled over into a sell-off in the S&P 500. And it was to the point where there wasn't enough liquidity in the S&P 500 market relative to the derivatives market, and the whole thing got blown out of the water. All right, so that's the short-term risk right now. If there are players who are stuck still over the weekend short a bunch of volatility on the wrong assets, if they are forced to cover, then it can still bleed over into index vol. I'm going to go look at some live charts for a second because I do want to show you this. So if you look at the S&P market and you look at how the stock or the index traded on Thursday, and it was just this grind to the downside. There really wasn't a whole lot of, it wasn't a collapse. We didn't see a bunch of negative tick readings. There wasn't a whole lot of aggressive selling. It was just this slow bleed lower. And that's because it was driven by option flows where the VIX, okay, and its related products really started to get hit right here. Okay, where it just, you saw this continued grind. So it felt like that there was a forced cover going on. So people were buying back their puts, they were buying back their short volatility exposure, and it bled over into index volatility. And then on Friday, the VIX gets blown out of the market. This is VXX, but you can also look at spot VIX if you wanted. And if you wanted to look at short-term stuff, you look at the 9-day VIX, and it ran from 22 to 32 during the first session. So that indicates to me that there is someone that got stuck in a short volatility trade. All right, if you traded GameStop, you saw what happened on the upside, where too many people were short calls and GameStop continued to rally because dealers were forced to buy back some of their directional exposure, causing that squeeze to happen. All right, we saw that on Friday in indices as well as broad tech. Okay. So I think that's all of the individual liquidity components. Oh, we got this one. I forgot about this. This is the spooky macro trade for me. And this is the Australian dollar relative to the yen. And the sell-off that it has seen over the past 2 weeks gives me great concern about global contagion. That call is very early, and I could be completely wrong on it. Okay, because the economic outcomes of something like this don't happen right after the financial market sees a move. There is a delay, right? So housing crashed in 2008. Housing didn't actually bottom until 2011 because that's how illiquid those assets are. So this could have significant second and third order knock-on effects, maybe not tomorrow, but 6 months from now. So the Australian dollar yen cross is what's known as the carry trade. And you could borrow out of the Japanese yen at a very low interest rate. And then you can lend to, in Australian dollar terms, at a much higher interest rate. And so you can actually express this view in the foreign exchange market. You don't even have to lend it out. You just trade the currency pair and you get a little bit of action on the upside. So, this is a longer term chart. I'm just going to go to a monthly chart because the last time I saw this really get truck sticked was 2008. This was one of the major trades that unwound. For those of you that remember, back in 2007, you had the China story. You had PetroChina, PTR, which had a larger market capitalization than ExxonMobil. And so that got big news. China was going to eat our lunch. You had the most amount of cranes and construction in China. You had all this concrete being bought, and you had oil going to $140 a barrel. And Australia was a very good place because they have a lot of commodity exposure. And you had this carry trade that was doing exceptionally well, and then the whole thing broke. And this did not help the liquidity crisis that we saw in 2008. So this is one of the major macro concerns that I have right now. If this sucker really starts to unwind, it's going to get ugly. This is not ugly right now, okay? This is just, this is basically normal for what the foreign currency market tends to do, all right? And this was corresponding, and we'll get to the catalyst section in a second, but this was related to the Bank of Japan hiking rates, okay? If it's still around, and I don't think it is anymore, there used to be an ETF, there used to be a carry trade ETF that, it was DBV, but I don't think it exists anymore. All right, that's a commodity curve carry strategy. This might be one. So CCRV may be a good proxy for the carry trade. We'll see. Okay, I go back to my slides because I get a little too distracted. In terms of catalysts, we had the Bank of Japan doing a hike. This is directly related to the yen being entirely too weak. And a lot of people were going to Japan because tourism is cheap. You can get a burger for $3 there. And that has really swung to the other side. I think there's a lot of stuck money there. You also saw there's a really good Japanese ETF that's currency hedged that really shows the destruction here, and it's DXJ. And this is a Japan hedged equity ETF fund. And it has been one of the best performing overseas markets that I've ever seen, because it's a combination of investing in Japanese equities as well as hedging off yen exposure. And, back from the lows in 2020 to here, it rallied 119%, and you caught a couple dividends as well, which is nice. But the whole thing has retraced all the way back to February of 2024. So there's probably going to be some stuck capital in this particular trade as well. Some other catalysts. Bad jobs data came out. There is something called the SOMRL, SAHM, basically saying, hey, if this certain thing happens with respect to the rate of change in unemployment, that could be an early recession indicator. All right, so we saw unemployment go up. That wasn't a good sign. Private jobs data has continued to deteriorate as well. And there's been this back and forth with respect to whether the Fed should cut or not. And that's just been a discussion that people have been having for, 2 years now. We were expecting rate cuts back in early 2023. If you go back and you look at the futures market and what was being priced in, and it just kept being pushed out because inflation continued to be steadily higher. Okay, and the Fed didn't want to run the risk after looking like a complete idiot saying the inflation was transitory in 2021. They're now really trying to get a handle on inflation because they don't want to look like idiots again. The problem here is that they could still look like idiots because the policy decisions that they made 6 months ago may not show up in the economic data until now. And that even if they want to change policy, the horse has already left the barn, cart before the horse. One of those. Basically, they can't do much anymore, because if they wanted to make a decision and we start to see convexity, negative convexity in the economy, that decision should have been made 6 months ago. All right. Right now, that argument has flipped, and we'll show some markets in a second, but that is still a very tenuous idea. So don't get completely sold on the idea that the Fed should have cut. We don't have enough data for it just yet, and trying to trade based off of a recession that could hit 9 months from now will not give you the best kind of expectancy. All right. So you just got to make sure that your trading matches your time frame. You can be concerned about this stuff, but liquidity matters the most. All right. So the bad jobs data came out, and all of a sudden the Fed expectations shifted. All right. So the Fed on the 31st of July said we're not going to cut rates this time, but we're probably going to cut soon. Now, the way the Fed works is that they make these decisions, and it's usually about once a month. They'll take a break every once in a while, and August is one of those times. They're going to go screw around at Jackson Hole or whatever, and that means there's a very long period with respect to rate decisions. And so it's not a coincidence that the market's starting to throw a temper tantrum when the Fed is not going to convene in August. So now the Fed fund futures market is currently pricing in a 50 basis point rate cut. On Monday, it was pricing in a 25% or 25 point basis cut, 25 basis point cut. There we go. And so there's been a shift in the perceptions of what the Fed is going to have to do. Now, the issue here is if the Fed has an interest rate policy that happens between now and the September meeting, it's going to be an intermeeting rate cut. And those scare me because it tells me the Fed is losing control of the narrative. And that can lead to changes in the liquidity of the markets. All right. We're just talking about perception and reflexivity here. All right. So If the Fed ends up losing narrative control and they get stuck on the back foot, that's not going to be good for with respect to what we think their policies are going to be in the next 6 months. And if you have a wide dispersion of expected Fed policies, then you can end up with more volatility in rates, in FX, in equity, and all these things. So it leads to more volatility until you get more clarity. Very good example of when that happened was December of 2018, where they hiked rates and things got really weird in the market, and they were forced to make updates on Christmas Eve 2018, which signaled that they had lost narrative control. All right, so that actually marked the bottom of the market because they introduced more clarity and a little bit of quantitative easing on the side, which helped soothe the credit markets as well as equity volatility, which caused a strong bounce. Okay, so that's why we're looking at the Fed. It's not about whether the interest rates are going to be good or bad for the economy. It's whether or not they're going to be able to control the narrative over the next 6 months, especially headed into an election and deteriorating economic data. This is the Fed Fund Futures market. This is ZQ, December ZQ futures. So you can see that strong liftoff. The last time we had this kind of move, it was pretty close to marking the bottom in stocks. All right, so that last push higher right here, and that was the end of 2022, I believe. That was the bottom for the market. So if the market overshoots and starts to expect too many rate cuts because the economic data is obviously getting worse, sometimes that's just the market being an idiot and can often be a contrarian indicator saying, hey, you know what, at least an intermediate term bottom is in. Okay, so that's why we want to watch that. We also had some tech earnings. This is an example. I'm pretty sure this is not December ZQ futures. This is Amazon. Amazon saw a decent gap down on earnings on Friday, which didn't help things. Apple had good earnings, so it rallied, and that helped buoy the market. If Apple had had terrible earnings and gapped down on Friday, we would be in a lot worse shape because that volatility unwind would have really taken place. All right. If Apple didn't have earnings and saw a move higher with a compression and volatility, which bled over into a drop in vol in NASDAQ options, then it could have gotten a lot worse. All right. So thanks, Apple. I'm pretty sure they had earnings, right? Hopefully I'm not overstepping right here. When was their actual earnings event? Yeah, it was on Thursday after, and if it had been bad and Apple had finished down at about 208, I mean, you can figure out where the NASDAQ would have bottomed out, but it would have been pretty gnarly. Okay, this one's kind of funny. This shows us the traffic on a Friday night at all the gay bars in DC, and they were all less busy than usual. All right, this is very similar to looking at when they deliver pizza to the Pentagon, because if you're delivering pizza to the Pentagon, it means there's a bunch of people there on a Friday night and that things are about to get weird. So if all the gay bars in DC are emptied out, that means the Pentagon, State Department, and the White House are completely staffed up because they're now concerned about geopolitical tensions, right? So you've got Israel, Lebanon, Hamas, you've got Iran in play. So that whole mess is still there. But we aren't seeing a response commensurate with geopolitical tensions in the crude oil markets. Okay, and so that might not be an issue, but it's one of those exogenous events that you just got to keep an eye out for. War does not necessarily mean down markets. When the U.S. invaded Iraq in 2003, that was the absolute bottom in the market. All right, sometimes what's the phrase? When the bullets fly, you got to buy, right? So that doesn't mean downside in the markets. All right. So path consideration. This is not me trying to make any kind of predictions. This is just about applying a framework, and then we can look for the nature of price action as it responds to certain narratives and certain catalyst events. So the near-term risk in the market is whether or not we're going to see equity volatility completely blow out. All right, and that's the big one. All right, so if we look at VXX, for example, which finished near the highs on Friday. If this continues to go higher, that's not going to be a good sign. Okay, and it's that simple. So ideally what you want to see is you want to see a new lower low in equities followed by a lower high in volatility. It means that the bloodletting in the options market is done, and if there isn't any more demand to buy back that volatility, then it no longer bleeds over into downside prices in equities. So we did see a small version of that on the open on Friday as we reached the European close. All right, there was a little bit of a shakeout in the markets with a new marginal low, but we did not see a new marginal high in the VXX, which was a decent bottoming play. So that's one to watch. If this thing really starts to get blown out, and we'll know on Sunday night if volatility futures go up a lot, then you probably want to buckle up and you want to look for some collapse kind of ideas. All right, and that doesn't mean the whole market's going to fall apart. It just means that option flows are going to dictate what's going to happen. So if you go back and look at February 2018, right here, this is the risk. All right, I don't think we have the same kind of environment as 2018, but if derivative flows get too one-sided and there isn't enough liquidity on the bid in equities to absorb it, then it just starts continuing lower until you get a snowball of suck. Okay, so as long as that doesn't happen, the market will probably find some footing. The broad markets did find some decent levels of support on Friday. That doesn't mean the absolute bottom is in. Let's just go back here. There we go. Let's swing it up. All right. So this is the NASDAQ, and the NASDAQ did come in, for example, it just retraced to this recent high. So it could be a bottom, but there's also some juicy levels just underneath, and that would be what the market likes to do, where you get that first bounce, everyone feels like a genius, and then you run those stops, and then that round gets blown out, and then we'll collect some bigger levels right there. So that's the short-term stuff. You also want to look for where the bounces could be on those 7 stocks, the Apple, Amazon, Meta, Google, Microsoft, and whoever I'm forgetting. And then you want to look at XLF, which did see some very nice support hold. There was a lovely support hold on Friday in XLF up against some big levels. And then you want to look at XLV as well, which is healthcare, which is exhibiting a massive amount of relative strength. And there may be some better plays there. Eli Lilly is probably going to be a decent dip buy candidate up against these levels. Like that's a pretty straightforward play. So if Mag 7, if those large cap tech stocks can manage to hold, and maybe the semiconductors start to find some support, maybe up against this swing AVWAP from October, that's going to come into play, then you might have a bounce. All right. That doesn't mean it's going to be the absolute bottom in the market. We could see a very high volatility, high reversion market based off of headlines and macro flows. So you just have to be a little bit more of an aggressive trader. Do not get super aggressive on short volatility. You don't have to short vol just because the VIX is up. Ask me how I know. All right. I've had some bad experiences thinking, oh, I should sell this fat volatility when it's a terrible idea. The intermediate term stuff. Are there going to be some second order effects from that carry trade unwind? All right. Are there going to be some stuck institutions that are going to try and unwind their position further, which bleeds over into other assets that I care a little bit more about, like US stocks? How much movement are we going to see in the Fed curve? All right. So as economic data comes out, are we going to start seeing convexity where negative economic consequences are really starting to accelerate and the Fed's going to be forced to lose narrative control and pivot much more aggressively and faster than what was expected? Or is this just people throwing a tantrum and it's just 100% positioning with respect to that short vol dispersion trade and the carry trade? All right. If those things unwind and the overall market's fine, then it should be good, and you'll see something a little bit better. The next thing, and I think this is really important, is if the Mag 7 trade is done for now, is the rotational dynamic going to continue to take hold? So are those large cap banks going to hold up? Are the regional banks going to hold up? Are we going to see a continued move back into industrials or other pockets of the market that have seen persistent underinvestment, that if institutions are like, okay, I'm done playing with you, Nvidia, let's go find something else? Or you have other asset managers that are like, thank God I didn't play Nvidia. Now maybe I can start playing some of the other parts of the market and try and outperform into the end of the year. That's how you can get a different kind of move in the market that a lot of people aren't going to be expecting. Okay, a rotational bear market's very possible right now, where because of how top-loaded the indices are, 50% of the weighting in the NASDAQ 100 is those 6 or 7 stocks. Well, those can pull back and a lot of other stuff can move higher, and the overall market, the index, will just kind of look okay. It'll just be range bound. And for those, who are just blind passive investors, they're not going to feel as good as they did in the first half of the year because it's now a trader's market, right? Which is, I'm biased. I'm hoping for that. I want to see that kind of price action. Long-term stuff, and I try to keep my blinders on. I don't want to think about this stuff too much because I don't want to let it affect my trading because that's beyond my time frame. I have a high amount of time available to trade, and I don't have liquidity problems like a $10 billion fund. So I can get in and out pretty quickly, and it's not a big deal. So long-term stuff, was the Fed too late, right? That's going to be a big risk. If we start to see an acceleration in some of the bad economic data, that's not going to be a good sign for them. If you look at the other instances in which the Fed has cut, we had the tech wreck in 2018, and we had the great financial crisis, and we had the tech crash in 2001. That's basically it. You can look at it. It's just, go take a look at the monthly Fed funds rate and look at the other instances in which we've seen cuts. And we haven't seen a lot of them, right? September 2000 was the first cut, right? July 2007 was the first cut. And then the tech wreck was June 2019. And if COVID hadn't happened with a ton of stimulus, both monetary and fiscal across the board, we probably would have hit a recession then too, because we were starting to see some spooky things. But a pandemic changes the math a lot. So that's going to be an issue. And monitoring debt contagion. So if junk credit starts to really blow out and we start to see credit spreads really widen out, the Fed's going to monitor that much more aggressively than they are like looking at just the NASDAQ, right? Their concern is going to be credit markets. When does the yield curve uninversion matter? So we did see the 230, so the 2-year and the 30-year yield curve go positive. All right, so it inverted and it's now coming out of that inversion. And 6 to 9 months later, there might be a recession. It doesn't mean a recession is going to hit right now, but heck, 9 months down the road, it could get a little bit weird. Another one to watch is to monitor Sunbelt housing. So Sunbelt's going to be things like Florida. It's going to be things like Arizona. So if you look at total housing inventory in the US, and this is the golden handcuffs theme, all right? So this is a big issue for real estate. A lot of folks have been locked into their mortgages because interest rates are at 5%, which means mortgages are at 8%. And so if you own a mortgage at 3%, you have zero incentive to sell. If there's not enough supply, prices go up. You've had home builders putting in new units and things like this, but it represents a short squeeze in housing. It's very similar to what you see in the stock market, right? You have people locked up into their asset and they can't sell because of rates. If rates go down and they list their properties, all of a sudden you have a lot more supply on the market. So this is the active listing count in the United States, all right? And back before COVID, the high was 1.4 million, the low was 1 million, all right? We haven't cracked 1 million active listings in 4 years, all right? The market, the housing market has yet to normalize, and we don't know what's going to happen when it does. And so if the Fed starts being a little bit panicky and acting like idiots with rates, all of a sudden, people who are like, God, I wish I could get out of my house, and then the Fed does a 50 basis point cut and then another quarter cut, then they're going to be incentivized to try and sell their houses. You get enough of those people and all of a sudden housing prices go down, right? And then that becomes another kind of second or third order risk. Now, if you look at Florida housing inventory, then it's going to show a different picture because Florida had a lot of people move here. They realized it was too hot and there's too many mosquitoes and things like that. And the housing inventory for Florida is back above COVID levels. So we need to see how Florida real estate does with the introduction of all this supply. If it absorbs it very well, then that's going to be good. If it really starts to nose over prices in Florida, then that could be a signal of what happens in the future. All right. And that's just a longer term stuff you got to kind of worry about, but I wouldn't worry about it too much. Okay. So that wraps it up We've gone through all the liquidity characteristics that were driving this sell-off. We looked at the catalysts that may not have been the liquidity issue, but we're going to see those catalysts dictate the narrative, which dictates the liquidity structure in the markets. So think about, all right, and this requires some thought on your part. Where do you want to buy the market? Where do you think the market could head to off of certain conditions with respect to how volatility responds next week? What do you think is going to happen to the structure of the market as we start to get significant changes in, for example, the treasury market? You look at the 10-year note starting to spike higher. So there's just some things here that are going to make it exciting. It's going to make it volatile, and hopefully it will make it profitable. So that's my prep for this weekend with respect to the big picture stuff, and I'll go down and I'll start looking for timing ideas there. But I hope you get a lot out of this. I know this is a lot to cover, but there was a lot to cover in the markets this week. And let me know if you like this, and I'll see if I can make another one later. Take care.